Hello, good afternoon. It is Thursday, July the 3rd. Time is 5:42 p.m. We're doing our monthly debt-free life program, also known as an infinite bank, also known as a smart bank, which is the new phrase that's coming out. So what is debt-free life? Debt-free life is an infinite banking or use of an infinite bank style program to help people rapidly eliminate debts using a life insurance product. I know it doesn't make any sense right now, but bear with me. All right. So what is debt-free life really? Well, the first thing we should be asking is these two questions that you see on your screen. And that's how you probably got here if you're watching this presentation and you were referred to by a debt-free life certified agent. Are you 100% sure you're going to have a great retirement, or do you have some doubt? That's the question number one. And question number two, if we could show you a way to get out of debt in 9 years or less, including your mortgage, without spending any more money than you're already spending today, would you want to listen? Actually, that number, I did a study on the first 100 programs that I did. And what I found that it wasn't 9 years or less. It was actually a range. It was 15 to 27 years early. So I had one of my clients that got completely out of debt, and it was a lot of money in 2.3 years. And then the worst case scenario, the client that had just taken a mortgage out the month before, we actually got that person's time frame down to 15.3 years. So we cut half the length of time on the mortgage. And if you've ever looked at your amortization schedule and you know how much interest you're paying, which we're going to focus on in just a minute, then you understand how important it is to get rid of those long-term debts like mortgages. And we can actually make the amortization schedule, which works against us in the beginning, work for us. All right, let's keep going. So if you're like most Americans, you make a good an average wage, but you're really close to not making enough money. And that's evident by the fact that the average American only saves 3% of their income. The average American spends 34% of their income on interest, and the average American spends 40% of their income on taxes. This is not the way this country was supposed to be. We should not have taxes this high, and we should not be paying that much interest. And that's part of the reason for that is because banks make it really easy for us to get in debt, and they make it really hard for us to get out of debt. And our program that we're going to be talking about today is going to talk to you about how to change those rules. If you look at that statement on the right side of your screen, 74 cents out of every dollar you earn goes to pay the banks and to pay government in the form of taxes and interest. That needs to change. If you're going to have a solid retirement, that's got to change. So if you're like most Americans, this slide's a couple of years old, so this number is actually higher now. But if you're like most Americans and you make a decent amount of money in your income in your lifetime, that $2 million, that's really not a lot of money over time. And the average American that saves money in this country, the average is 3% of their wages. And if you think about it, if I'm making $50,000 a year and I work for 40 years, then I will have made $2 million. But if I'm only saving 3% of my income, then I was making 50,000 and then I'm going to retire with only 60,000 to my name. It's not going to last long, folks. So something's got to change. So if you happen to be in debt, that's probably one of the big things that's causing you not to be able to fund your retirement plan the way you should. And if we can show you a way to get out of debt faster than you thought possible, to be able to pay off your debts sooner than you ever dreamed, without you having to go out and get a second or a third job, then that's why you're here. If you go talk to somebody else, kind of like a debt counselor or a debt consolidator, some of those things that you see on the right side of your screen, those are the things that people are going to tell you. They're going to go tell you, go get another job, spend less. If you could spend less, would you be where you are now? Save more. If you could save more, wouldn't you have more than you do right this minute? Refinance. Not really. All you're doing is kicking the can down the road. Consolidate. That's like taking a pile of something that smells bad, a bunch of small piles of something that smell bad, and making one big pile of something that smells bad. Consolidation doesn't work, folks. It actually hurts you. And finally, that last bullet that you see there, debt snowball. What we're talking about with the debt snowball is not the thing that Dave Ramsey talks about. What he's talking about is actually called a debt stack. We're talking about a true debt snowball, one that really works consistently, not some of the time, and one that really does help people get out of debt quickly. And we'll talk more about that in just a minute. Our better way. This is what we want to do. If you're on the left side of my screen or your screen, we want to get you to the right side. You'll notice the difference, but the dividing line between these two structures is not go out and get another job. It doesn't say that. It doesn't say make more money. It doesn't say any of that stuff. We're not talking about doing anything with your finances other than changing the way you spend money. I would like to make it so that you're not saving just 3% of your income, but saving 15% of your income. If you're doing the math, that's a 500% increase in the amount of money you're saving for retirement. We'd like to get you to the point where you're reducing the amount of money you're paying out on interest from 34 to 22%. That's huge. And then finally, we want to get you to the point where we're saving on taxes. We're going to get you a 25% reduction in how much you're spending on taxes from 40 to 30%. I didn't say go out and spend more, make more money. I didn't say go out and get a job, get a raise. None of that. It's making the same amount of money you're making right now. All we're doing is changing the way you spend it. And that's what the Debt Free Life program is all about. Spending money in a smarter way. Most every person I talk to is either spending money or saving money inefficiently. What's that look like? Putting in 5% into your retirement plan when you're only getting a 3% match. That's an inefficient way to save money. Spending hundreds of dollars on a life insurance policy that's going to end up worth nothing. That's an inefficient way to spend money. Let's keep going. All right, so how do we do it? We're going to reduce how much you're paying in taxes. We're going to eliminate all your debt 9 years left, 9 years or less, or what I said earlier, 15 to 27 years early. We're going to reduce the amount of taxes you pay over time. We're going to increase your cash flow. So that's really a critical thing, because if we do this program and you're spending more to keep the program rolling than you were spending previously, you're not going to stay with it for very long, which means the program's going to fail. So we have to increase your cash flow, and that'll happen fairly quickly. And then finally, we want you to retire with a tax favored income. There's different types of tax favored incomes. One's called a tax deferred income. That would be something like a 401k or a 403b or any traditional retirement program. Another kind is a taxable income, where you've got money that you've got an income stream coming, but you're going to have to pay tax on it when you retire. Another one, and I think the best, is one that's tax exempt. So if you have two people, one person's making $60,000 a year taxable income in retirement, and one person's making $50,000 a year tax exempt income, who actually makes more money? Right? Why? Because he gets to keep all 50. And if you look at just a 22% tax rate on the person that makes $60,000, they're losing $12,000, $13,000 of taxes. They're making 45, 46,000 realized income after taxes. Tax exempt is the way to go, folks. All right. If you've gotten here on the YouTube channel, or maybe through TikTok or other social media, whatever, you have probably seen a lot of stuff out there. There's a lot of people hawking programs that really just don't work over time. There's one that's called the Australian model, where they say, yeah, don't ever pay your house off. Get a home equity line of credit and just use that as a checking account. No, 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 no. There's another one out there that, instead of using what we use, which is called participating whole life, they use an IUL, That's fine, except you've got limited access, you've got a potential loss, you've got a potential major tax gain in the end if you don't use it right. There's too many problems, too many variables with an IUL. Both of those programs I just named, they don't come with an emergency fund. And that's what one of the things that sets our program aside. You're going to have access to your funds. You're going to have access to a lot of money, and we're going to have access to it whenever we want. And there's going to be access to a little bit more that if you have a true emergency, not a I need to take a trip to Fiji emergency, but my brother lost his job. My sister-in-law doesn't work. They've got three kids. They've got no income. And if someone doesn't make their mortgage payment for the next 6 months, they're going to lose their house. That's the kind of emergency I'm talking about. In our system, we have something set aside for that. All right, I talked a minute ago about different types of income, tax deferred, tax free, taxed. So most people are familiar with tax deferred programs, 403k, 401a, 457, TSP. If you're a federal government employee, FERS, KEO, SEP. You got some state retirement systems. If you're in Florida, the FRS system, stuff like that. Most people are familiar with tax deferred programs. And the key problem with tax deferred programs is this. If you think about it, if I'm saying it's in the name, tax deferred, if I'm saying tax deferred and I'm growing the nest egg in the program, I'm also growing the tax. Quick question. Oops, sorry. Oops. There you go. Quick question. Does anybody out there think that taxes are going up or down? I didn't hear you, but I would assume that just about everybody said they thought taxes were going up. Last time I looked, we were almost $37 trillion in the hole as a country. And it looks like it's going to continue going up. So the only way that the federal government can pay down our deficit is they have to do one of two things. Actually, they have to do both. They have to stop spending money, which getting a politician to agree to stop spending money is probably never going to happen. And they have to raise taxes. That's it. So if anybody thinks taxes are going down in the future, you need to rethink that. So that means that if we're putting money into a tax deferred program, we're saying, hey, I don't want to pay tax on my money right now. I want to pay tax on it later when I'm going to pay even higher taxes. That's the fallacy of a tax deferred program. That's why Ted Brenna, the father of the modern 401k, said people shouldn't be putting money into 401ks. People should be using this type of program. And he didn't say the word infinite bank. He actually said a 501k. Then he explained a cash value life insurance policy that shelters money from the IRS and from taxes. So all that discussion was to lead you to this screen. Is tax-free better or is tax-deferred better? If we look at a simple $10,000 investment running over 28 years, where we're gaining 7% interest average, and we're at a 25% tax rate for the taxed programs, it's hands down. The tax-free program is going to be best. Bite the bullet, pay the tax up front, let the program compound and gain for you. Okay, I'm off that soapbox. On to the next one. The next one, folks, this program isn't new. It works just like any other financial system. Maximization, accumulation, distribution. If you're in debt right now, then you are at the beginning stages of the maximization phase. What that means is you're in the process of trying to be able to put as much money into retirement as you can. And you're hampered from doing that right this minute. You're hindered because you're having to pay debt service on your debt. So the faster we can eliminate your debt, the better off you're going to be, not just in the way you feel, but also in your retirement. And maybe you can even push up your retirement. Maybe you don't have to work till 70. The accumulation phase is when you've reached that pinnacle of how much money you're putting in. The only way you get there is by eliminating your debt. And so we want to get you to that accumulation phase as quick as possible. And then the distribution phase, that's like every other retirement system out there. Distribution is when you take the money. How are you using it? It's your call. What are you using it for? It's your call. But distribution means you're able to take money from the system. And that's where we want to have the most amount of money possible available to you so you can have the most comfortable retirement. The system isn't new. This has been used over many, many, many years. The oldest one I can find was done in 1904 by John Rockefeller. Walt Disney used it to build Disney World. Pampered Chef was started by Doris Christopher with money from her life insurance program. She used it as a quote unquote bank. Ray Kroc used it to fund the first 11 McDonald's units that he started. Warren Buffett uses it to this day. It's a leverage tool, folks. And if Buffett agrees with it, Buffett likes it, Buffett uses it, I'm certainly no one to tell Warren Buffett he's wrong. So I agree and believe Warren Buffett. Let's keep going. So at the end, what we're going to do is we're just going to change the way you spend money. We're going to stop spending money inefficiently, and I'll show you that in just a second. We're going to stop saving inefficiently. We're going to get rid of your debts as quickly as possible. We're going to process that debt elimination strategy with policy loans. We're not taking our principal, we're taking loans. And then when the big upfront purchases come in the future, you're going to have to buy a new car. You need to put in a new transmission. You want to pay for your child's college. You need to pay for a wedding, whatever. When those big purchases come up, we'll have money in our system to be able to do that when we want to. We won't have to go to the bank and beg them for cash. We'll have it ready for ourselves. Last thing in that last bullet, this is really kind of a big deal. In the end, we're using this as a cash growth vehicle to help rapidly eliminate debts, get us to that process where we're saving more for retirement. That's our goal. But in the end, it's still a life insurance policy, and it comes with all those protections and that legacy creation that life insurance can, and in this case, will create. In the grand scheme of things, if you think about it, let's say you owe $300,000 of debt. If you utilize this program, you're going to capture about 60% of what you owe as a cash value that you can use for retirement. In addition, that $300,000 of debt and the $220,000 or so that you get to keep, that's going to create at least another $300,000 or $400,000 of death benefit. So not only do you get the cash, you get that legacy creation too. All right. That's great. These are old slides. The average person that I run into these days has way more than $84,000 worth of debt, way more than $100,000 worth of debt. The one I did this morning, that person had $472,000 worth of debt. These programs work. They work quickly as long as you follow the system and stay with the program. All right. In order for you to be able to do this program properly, you need to understand how you spend money. So let's talk about that. This is what you currently do. When you go out and you make a wage, whether it's because you're a 1099, W-2, W-4, doesn't matter. You make a wage, you earn that money, you deposit it into your checking account. It doesn't matter what bank you use, whatever brick and mortar, credit union, regional bank, national bank, it doesn't matter. They all work the same way. When you put money in your bank account, every night your bank lends that money out over and over and over again. The average dollar that you put into your bank account is going to earn your bank 61 cents, and they're not going to pay you anything. The average length of time it takes you to actually spend that dollar that you put into your bank account is actually about 7 days. So after you've left your money in the bank and you've left it there for 7 days, and they've made 61 cents for every dollar you put in there, and they've paid you nothing, then it becomes time to pay your debt, whatever the debt is. I'm going to say a car in this example. So I have a car that I owe some money on. I have a $500 payment and the car is paid off. So I'm going to write a check from my bank to pay that debt, and that money becomes their money, they being whoever owned the lien on the car. So I've transferred $500 of my money to a creditor, and they have given me the title to my car. And the bank made a bunch of money with my 500 bucks. They made $400, 320 bucks, something like that. They didn't give me a penny. As a matter of fact, the only thing they did for me was they said, "Hey, Scott, thank you for keeping at least $2,500 in our bank in your checking account. Because you did that, we're not going to charge you a fee to keep your money in our bank." That's how they work. That's how they say. And that's what they do. Well, folks, there's a better way. Call this the debt-free life method, the DFL way. Nothing changes. You still make money. The money still gets deposited. Your income still gets deposited into your checking account. But this is where the change happens. I'm going to divert the money once it hits my checking account, and I'm going to pay my life insurance premium. That's a critical thing. Life insurance premium. I'm buying, remember I said earlier, there's different kinds of programs and IUL, stuff like that. I'm using participating whole life, the very thing that I'm not going to mention his name, the very thing he says you shouldn't be using. I'm going to put money into a whole life policy. Now, what's actually happening here when I pay my premium? When it reaches the carrier, it's being split into three parts. Some of it's going to whole life, and even smaller amounts going into term, and a much, much larger, the lion's share is going into paid up additions. And I'll explain that in just a second. But in the end, instead of leaving that money in my account for the bank to use and not making me any money, I've moved that money up into my infinite bank, my private bank, my smart bank, my debt-free life bank, and I've changed the rules. Now I'm earning money with my money, and the bank's not. When the money hits your account, it gets split three ways, like I said. Whole life. Why whole life? Because whole life allows you to build a cash value by default. Why do I have a term rider? This is because of the IRS, folks. IRS tax code 7702A. All money derived from a life insurance policy is tax exempt unless the cash value of the life insurance policy exceeds the death benefit, in which case it becomes a modified endowment contract and it's all taxable. So what I'm doing with the term life rider is I'm increasing the total death benefit of the whole life. So if the whole life is a $20,000 whole life policy, I'm adding $200,000 a term. I'm 10xing it. And that leaves $220,000 of cash value that I can grow in there that's shielded from the IRS. Then that third part, paid up additions, right? What is that? It is exactly what it says, paid up additions. It is paid up additional life insurance. Now, before you go off and think what you're thinking, let me explain. Banks look at investments and grade investments by risk. So, as an example, a bank could make a loan for an individual to go start a restaurant. And that individual could be a 21-year-old busboy that's worked in that restaurant for 2 years. And that bank would be very foolish making a loan, but that would be considered a tier 4 asset, which is the riskiest of all kinds. In the same respect, a bank could buy a pound of gold. That would be a very safe investment because we know that it definitely is going to have value. So they consider gold and precious metals tier 1 investments because they're safe. But here's the thing. Have you ever seen gold lose value? Yes, it has. And it does. It fluctuates. So if I have something that fluctuates and I'm trying to balance my books, I can't really use gold as a tool for that because the value of gold fluctuates. Hopefully it fluctuates up, but it does fluctuate down. So therefore, yes, they do buy gold as a tier 1 asset to protect and pad their bottom line, but they buy a lot of life insurance. And what do I mean by that? I mean, if you've ever been driving around and you heard those ads that come on the radio that says, hey, if you've got a life insurance policy worth $100,000 or more, don't cancel it. Call us first. It's probably worth money and we'll buy it from you. Those companies are called viatical settlement companies. And what their job is to buy life insurance with permanent value at significantly lower amounts than what that permanent value is. Usually that number is somewhere between 3 and 8%. So if I have a $100,000 policy, they'll pay me $3,000 for it. I get $3,000. I list them as the beneficiary, give them the policy, and I'm done. Viatical settlement companies. And then the banks buy that because the viatical settlement company bought it for 3 grand. The bank's going to pay them 6 grand. Not a bad return. And the life insurance value of $100,000 is now on the bank's list as an asset. So it increases their assets, which allows them to lend more money. This is how banks do it. It's not just banks. Heinz, for example, they buy a ton of life insurance. Certainly banks do. Car manufacturers, every large corporation in the country, I won't say that. Most large corporations in the country actually purchase life insurance to pad their bottom line. So going back to our decision here, right? We've moved money up into our whole life policy. We also bought a term life rider and paid up additions. About 60 or 70% of our paid up additions is where we're going to buy additional life insurance and we're going to use cash to do it. And that's going to register in most cases as a cash value in a one-to-one relationship. So if I buy $70,000, if I spend $70,000 on additional life insurance, then I have $70,000 of cash. And there's usually a factor of 1.4 to 2.0 on the amount of death benefit I create. So that same $70,000 created $70,000 of cash value and maybe as much as 140,000 of death benefit. And that's critical when we get to the next step, and I'll show you that in a second. But now we're to the point where we've got that earning money on our money. We put the money in the bank. We're back to that same example as before. I got that car I got to pay off. I need to take money out of my bank to do it. Do I want to write a check from my checking account, spend the money one time? No. What am I going to do? I'm going to take a loan. So I take a loan against the cash value. I don't take my cash. I take a loan against the cash value. I put that money back into my checking account. I tell my bank to send that money to my creditor. My creditor receives it. The car gets paid off. I now own the car outright. Where's my money? My money is still in my Infinite bank. It's still in my DFL bank. It's still there. I didn't take my money. I took a loan against my money. Is this better than just writing a check and sending it to the car company? Yeah. Why? Well, if I just write the check out of my checking account and send it to the car company, then I've traded whatever that amount of money was in cash flow for exactly the same amount of money in equity. Has anybody ever gone to a 7-Eleven and tried to spend equity? Can't. Did I have a gain in that example where I sent the check directly from my checking account? I did not. If I look at an equation, $500 over here, car over here. Take the 500, move it and pay the car off. Now I own the car, but my 500's gone. What is my gain? My gain is zero. I transferred cash flow into equity and I've got no gain. In the example you see on your screen right now, the minute I take the carrier loan and pay the car off, I now own the car. I have 100% equity in the car on this side. I still have my cash over here. It's in my Infinite bank. What did I just do? I increased my net wealth by 100% of the value of that vehicle, as an example. This is why infinite banking strategies are so superior. because you get to have your money and eat it and use it too. This is the only investment of its kind on the planet where you can have money in two places at the same time. I have money in my infinite bank earning interest in a dividend for the rest of my life. I have the widget that I just bought, whatever that asset is, it just increased my net wealth. I get both at the same time. So that's how debt-free life works using a debt-free life bank in opposition to what you normally do with your regular bank. It's a much smarter way to do things, in my opinion. And the banks that are out there do not want you to do this because you are the lifeblood, your savings account, your checking account, your money market account, your high yield savings account. You think if they're paying you 5% that they're not earning 40 or 50 or 60%? Of course they are. When you drive into a big town and you look at the names on the tallest buildings, who's usually on those tall buildings? It's usually a bank. They make tons of money, folks, and this is why. Because they borrow money from you, 0%, and lend it out at whatever they can get. It's called arbitrage. All right. This is where we're going to stop for a second. All right. And I'm going to see if anybody has any questions. Here we go. Hi, folks. Lady Dulce Garcia.
I have a question.
I might have an
So,
answer. I might even be right.
okay. Um, so who would, I know I've asked this before, but like, who would qualify for this? I know you said, someone making good amount of money, they have debt,
Right.
but like if I'm looking and
Right.
networking and, kind
Right.
of who would I bring
So
forward for
there's
something like
two
this?
qualifying factors. Number one is a financial qualification. So if someone is on the verge of bankruptcy or someone is playing the shell game with their debts, like I've got this credit card that's 24%, but I can go over here and put it on a credit card that's 0% for 6 months and they're constantly doing that, that person is probably not a good candidate for this. If their method of managing money is simply to swap credit cards. Um, unless they really want to get out of that schedule or get out of that rat race, in which case this will really help them. So the person has to be financially solvent, whole. They can't be, like I said, near bankruptcy. Because if they're near bankruptcy, this isn't going to stop it, and this isn't gonna help them. So they have to be able to pay their debts. So what the first thing I look at when people have when I meet with people is what does your debt load look like? How much do you owe? What are the things you owe money on? How much are you paying? Are you paying anything extra? Okay. That kind of stuff. And if the answer is across the board is yes, I owe this much, yes, I'm making payments, as long as they're making the minimum payments, then financially they're going to qualify. The second way they have to qualify for is by health. This is still life insurance. This is not a guaranteed issue product. You have to go through underwriting. The underwriting is pretty stringent, and it can take, in some cases, there are some programs out there that are instant underwriting. And in some cases, there are programs that take weeks and maybe even months. It just depends. But the point is that they have to be healthy and they have to be financially able to do it. Is there a minimum? Maybe that's what you're looking for. There is no minimum. The cheapest one I've ever done was 48 bucks a month. The most expensive one I've ever done is $100,000 a month. So, there's no, it's just, does it make sense? Does it make financial sense? Is it going to improve their situation? Does that help you?
Yeah, that
Okay.
is helpful.
All right.
Thank you.
Go ahead, Leah.
When you say health underwriting, does that mean just like the typical questions that we ask, or are they going to actually have to have a physical, a
Right. So
medical
you're talking
physical?
about full underwriting versus simplified underwriting versus instant underwriting. Good question. It depends on the carrier. There's some carriers will offer a product that is instant decision, but if you think about it, they're offering an instant decision program. What are they sacrificing for to be able to offer that so quickly? And
Right.
the sacrifices we're not going to know now because those programs are relatively new. We'll know 15 years from now. And my gut feeling is that the programs are not going to perform as well over time because the carrier can't. They can't do the full amount of research that they should do if they're going to be on the hook for a whole lot of money, which they are. They need to overturn the rocks. So there's different levels of underwriting. Depends on the client, how deep they want to go. And if it ends up being a fully underwritten program, which some of these will be, that's pretty strict. They're going to look at everything. They're going to pull medical records. They're going to pull prescription drug histories. They're going to pull driving records, police records, credit reports. They're going to look at all of it. And then they're going to make an educated decision before they offer a program.
Okay.
So it runs the gamut. And then there's some like there's a company that I like that does most of their stuff is fully underwritten, but if the person is younger and they're healthier, they'll do rapid underwriting, which can only take about 2 or 3 days. And then there's another company that I like, which has an instant decision product, and that's great for young, healthy people. We can get one set up, go through an application process, and that policy can be in place inside of 30 minutes, maybe. So it can go enforce that day. First premium, you're off the races. It just depends.
What about someone who's close to 60 years old? Is this going to, I mean, yes, it can
So
help them, but is it going to be as beneficial?
right. So from my perspective, any program is beneficial to anybody that can qualify for it if they have a debt load.
Okay.
So, and realistically, the functional age to take one of these out is really up to age 70. There's one carrier we have, or one company I know of, that will actually offer these programs to people over 70, but they also have a much higher minimum death benefit, which means you're paying a whole lot of money for death benefit. So if we're trying to eliminate debt, but we're bringing on a large, expensive life insurance policy, it's not going to do real well for that debt elimination strategy because it's not going to leave as much money available for debt elimination.
Yeah. Are these carriers that do this type of product the same carriers that we're doing that we typically are using, or are they different?
No, these are all carriers from the IMO that we use,
Okay.
and they're
Okay.
good companies. So our IMO would not every single one we work with is an A-rated carrier first off. So I know the folks that are IMO would not choose a poor quality carrier, and they haven't. We've got really great programs, really great products. There are others out there, and some of the ones that are outside of our IMO that I've looked at, they don't perform as well. So I think we really do have the cream of the crop of the best ones that are out there. So it's just, um, it's just there's other options, but I'm not going to advertise for any of them
Sure.
today. So because this is eventually going to be, up on social
Are
media.
there any yeah. Are there any like minimum income requirements?
Well, and this is where it becomes a kind of a common sense thing. If you have someone who's on disability and they make $1,100 a month and have a mortgage that's $600 a month and they got to feed themselves and pay their power bill, gas bill, water bill, and they're trying to take out a program that costs $500 a month, the underwriter is going to throw a red flag, just like I
Sure.
would. And they're
Sure.
not going to, how do you plan on paying for this? You can't not eat.
Right.
You can't default on your mortgage.
Right.
So it has to make sense. The math
Yeah.
does have to match, and they're going to ask those questions. They're going to ask, what's the income level?
And
What are the monthly expenses? They're going to ask.
and is it like a mortgage where they want you to have at least be in the same industry for the 2 prior years?
They don't ask what you do for a living in
Okay.
most cases. It doesn't matter. It's just they're asking what's your money. So for
Okay.
example, I have a client the other day who drives Uber in the morning, um, owns 3 cars that he has with some car rental company that rents out his cars, and then he works in the evening as a cook in a fast food restaurant. So he's got 3 different sources of income. That was not asked on his application. It wasn't disclosed, and it doesn't matter. It's just what is your income? What are your expenses? Is there enough money between income and expenses for you to be able to pay the premium? That's what they're looking for.
Sure. Okay, that makes sense. Thank you.
Sure.
And I was going to ask that kind of what we're talking about. Like, even before we get to the insurance company, they're going to ask for financials. Doesn't make sense. But even before we do an application, they've got to have some disposable income, right? If they're just paying the
Right.
bills and don't have anything, they've got to be able to do that $500 premium. If there's no extra money in there, this really wouldn't work if they're right.
Right. So what we do, and what if we're using debt-free life, if we're doing a debt elimination strategy, we need to know what the debts are.
Mhm.
We need to know how much they're spending and what the minimum payments are and what the interest rate is. That's one of the places where we uncover where people are spending or saving money inefficiently. So if
Mhm.
someone is making a $500 a month overpayment on their mortgage, that's not an efficient way to eliminate the mortgage.
Okay, so
It
they could
works,
be running
but
tightly, but you'll uncover money where
right. So there's
okay.
there's five primary places where people spend or save money inefficiently. The first place is overpayment of debts. The second place is overfunding retirement programs when there is no match. The third place, most of the life insurance policies that I've run into that were not written by someone in our IMO are usually of inferior quality. They're either really high priced or low face value. Either way, the cost per unit of insurance is too high. So we
Mhm.
can usually look at replacing those with, and again, we're looking at this is life insurance.
Mhm.
You know, if you're spending $100 a month on a term policy that's going to expire in 10 years, maybe we should spend $100 a month on a whole life policy that's going to be permanent, and we can peel off 60 of that 100 to go into cash growth. So this
Mhm.
is the kind of stuff we
Okay.
look at.
So you could
So,
replace it 1035 the
yeah,
money if there's money in there. Okay. So
sure.
even though somebody may look, you're sitting down with somebody, it's like, wow, they're really running tight. It really has to, you really need to
Right. It
dig
has
in
to
and
make
find
sense.
out. Okay.
And then the last place we would really traditionally find money is people that are saving money inefficiently. I don't mean for retirement.
Mhm.
I mean, I've got a client that I worked with 2 years ago. She puts $200 a week into an envelope
Mm,
so that she can have money for Christmas shopping. I understand the concept.
right.
However, why don't we put that $200 a week into an interest earning account and
Right.
then pull the money when we're ready to go Christmas shopping? And that's one of the things you can do with an infinite bank. And then finally, I've got my money in a savings account. Oh, yeah? What kind of savings account? How much are you earning? 0.25%. I can 12x that for you using
Yeah.
our program. So, there's lots of places where people they think they're doing the right thing. It makes sense to them. Maybe they saw a YouTube or a TikTok thing that said do this, whatever. I don't really know. But they were given poor information or they were giving an inferior method to do the thing, to pay your debt off early, to save money for retirement, to put money away for, a nest for a rainy day, whatever.
Yeah.
They're giving methods that maybe 30 years ago might be appropriate, but certainly today they're not. And that's where we typically find the money to fund these programs. I can tell you of the probably 1,500 programs I've written at this point, maybe 20 of them were for more money than people were already spending inefficiently. Almost every single one of them were places where we had found money that they were saving or spending inefficiently.
Mm,
And if you use that method when we're designing the program, if you use that, then a couple of things are going to happen. Number one, the client, or you, if you're the client, you're not going to feel any difference in your cash flow. It's
right.
just changing it. You're instead of you spending $500 extra to your Amex card that month, you're just paying the minimum and you're putting that $500 to work for you forever. And that's all we're doing. That's all. And when you adopt that strategy, you're going to have a higher rate of issuance,
Mhm.
and you're going to have a very, very low rate of cancellations. My cancellation rate is less than 4%. So, this is people once they get into these programs, they don't quit them and they
Right.
don't stop because the reason why they got into them was so strong. And once people understand or they see like a presentation like this, where someone kind of lays it out for them of why they're spending why what they're doing isn't working the way they thought it was going to work, or why they're not getting the kind of return that they thought they should have. It's a nice thing. I love seeing the light bulb come on in my clients' eyes. Here's
And how
another
quick,
example. I have one more thing because this
okay.
just happened today also. I have a gentleman who had $260,000 and a mortgage of 120. 2 weeks ago, before I talked to him, 2 weeks ago, he took 40,000 out and threw it at his mortgage. I appreciate that, but all he did was turn $40,000 of cash flow into $40,000 of equity.
Mm.
When I showed him the system, he didn't say it. I didn't say it. He did. He said, "Holy cow, I could have put that 40 into this infinite bank first,
Mm.
a loan, and then put it at, and I'd still have the 40." Yes, you
Because
got
it's gone now. Yeah.
and it's gone. Don't cry over spilled milk. You helped yourself. You eliminated some down the line interest. Celebrate the win that you have.
Mhm.
Let's go ahead and fix it though, so that you don't do that again. Or at least the next time you pay that $80,000 of remaining on your house off, you still have the $80,000
Right.
and it's earning interest for you for the rest of your life.
And how quickly, like somebody starts this today, right? So they've got
Right.
bills they want to pay. They're paying the premium. They're also trying to pay their minimum payments. How quickly can they get the money out of this policy?
How quickly are they putting money in?
So right away.
There you
It's
go.
it's available because of the PUA rider and all of that. It's
Right.
available.
The
You put it
PUA
in.
is, yep, the PUA
Okay.
is immediate cash recognition. The minute you put
Okay.
the money in there, the money's available.
Right. Because traditional whole life, it takes a while for it to build up to get any loan value, but that PUA rider is what's driving it.
Right, because we're
Okay.
not waiting for the cash value to build up in the whole life component. We're
Okay.
we're immediately placing the cash in the PUA, which is the same reason why IULs aren't as
Right.
successful as whole life in this scenario,
Because they
because
don't
it
have that
takes it
PUA
takes
rider.
time for the IUL to build up the cash value.
Right. And then the term rider helps avoid the mech
Yep,
situation.
it's exactly
And
that's the only reason why we do it.
and does that go away after time? Like term rider, is it a
Right.
10,
So
20
here's the
year?
thing. So when you're looking at meching, there's
Mm-hmm.
a 7 year window because of TAMRA.
Mm-hmm.
So if I make premiums for 7 years and I haven't made it become a mech at that point, I can not cancel the program, but I can stop. I can do what's called an RPU,
Okay.
reduced paid up. And at that point, the term rider goes away, but I'm not adding more money into the system other
It's
than
kind
what's
of
coming from the organic growth of the system. So in that scenario, when you actually go read tax code 7702A, I simplify it when I say it's because the cash value is not exceeding the death benefit.
mm-hmm.
That's a simplification. What it really says though, it talks about premium. So if I'm spending more money in premium, significantly so than their calculation, that's what it's about. Because you'll see this when you run illustrations for clients of different health categories.
Mm-hmm.
You'll see that two people that are identical in everything, except that this person got a standard rating and
Mm-hmm.
this person got a table 4 rating.
Mm-hmm.
The person with the table 4 rating, if we don't change anything and they both have the exact same policy, exact same age, and everything to start, the person with the table 4 rating, all of a sudden, the amount of money they can put into the system on an annual basis is going to skyrocket.
Mm-hmm.
Okay. And that's because of the cost of insurance.
Right.
The amount that they're getting insurance wise is decreased.
Mm-hmm.
The death benefit has decreased, but
Mm-hmm.
the capacity of the program has increased. So,
Mm-hmm.
in that example, with someone who's a table 3, table 4, table 5, that's actually a win in
I
my
was
book.
gonna say it's actually almost better, right? You don't
Yeah.
normally want to see
If
a
we're
table
doing it for
rating.
cash growth, like in the end, life insurance and the underwriters that we work
I
with,
gotcha.
all they're
Yeah.
looking at is death benefit. That's what
Right.
their
Right.
concern is. And
Okay.
I don't care about death
Mm-hmm.
benefit. I'm
Mm-hmm.
not doing this for death benefit.
For death
So,
benefit, right.
so if I can spend less money to get the minimum amount of death benefit I need to get the maximum amount of cash I can put in there, I'm going to do that every day of the week.
Mm-hmm.
And that's a good thing, really, when you start thinking about it, to be able to streamline these programs and have more of our clients' money going into cash growth. It's a good thing.
Makes sense.
All right. Any other questions?
I have a question, Scott.
Sure.
And I don't know if I have heard this term before and I just don't remember what it is, but can you explain what you mean when you say POA?
PUA stands for pay.
PUA.
Yep, paid up additions. That's what it stands for.
Okay.
PUA.
I was thinking
So
POA and I couldn't figure out what it was.
yeah, POA. That's a property owners association for real estate. We don't care about that. So
Or a power of attorney, which is what I was
or
thinking.
power of attorney, right? All right. So PUA is a rider that can be added on to whole life policies. And that's where when we're designing the program where it's going to hit the carrier and split, that's where we want the majority of the money to be going into PUA because that's why we're doing this. We're doing this for debt elimination. Or if you don't have any debt, we're doing this as an infinite bank, which means we want more money going to cash growth. It's the same thing. Okay.
Okay. Yeah.
In
So yeah, that
general,
was one of the three. There was the term, the whole
yep,
life of term, and then this POA.
paid up additions, right?
Okay, got
In
it.
general, we would when we're structuring these in general, especially when you're brand new, your target should be about 60% should go into PUA. Okay. Later on, when you learn how to manipulate the illustration software, I try to streamline it from the beginning. So, for example, if I've identified through overpayments and 401k contributions that aren't being matched and overly expensive life insurance policies that are going to place and putting too much money into a savings account, they don't need to put any more in. If I do all that and I identify that $400 a month can be repurposed into this program, I'm gonna I'm gonna streamline it, and I'm probably actually gonna do an illustration that's only about $100 a month, maybe 110, 120, putting the bare minimum into PUA. This is not what you should do in the beginning. This is what you should do after you understand how to manipulate the software. And then I'm going to present. Yep, this program is going to be 110. Everybody's happy, right? It's much cheaper than what they thought they were going to do. And then when you get to the point where you're able to start putting that extra 300 and change that we found, this is what's going to happen. And when you did it like in that example, what I just created was a 75% efficient program. And that's, when you're looking at other companies that are out there that are not part of our IMO, they're just out there trying to get as much premium as they can so they can get as much commission as they can. That's not the way we do it here. That's not the way I do it. And I'm just trying to do what I can to get the most growth for the client. And
Yeah.
putting more money into the PUA is where you get the most growth. And if
Okay.
you have that client where we identified 400 and all of a sudden my presentation is for 110, it is a no-brainer for them to sign and take the program. And then when they get it, and I show them, and they've watched one of these videos or talked to somebody else or whatever, and they said, "Yeah, I got a program. It's 62% efficient. I'm doing great." And then they're coming out of the gate at 75, and then you show them how it works, they're going to find more money. And this happens all the time. And all of a sudden, hey, Scott, can I put $800 a month into my program? I know we only designed it for four. Yeah, sure, go ahead. And now what happens? Their program isn't 75% efficient because of that $800 payment. They've got 700 going into cash growth and 100 going into just life insurance costs. Now that program is whatever 7/8 is, so 88% efficient. Holy cow. Is there any possibility anybody's going to come behind me and write something more efficient than that?
Yeah.
Nope.
And what does
No chance.
the paying money and getting money out look like? I mean, it's not like going to the
Right.
ATM, how does one do
Right.
that?
So there's an online access for all of our carriers.
Okay.
So one of them, a company called Lafayette, if the loan is less than 5,000, you can pick up the phone call and that's how they do it. Process it with a phone call.
Okay.
If it's either of our other carriers, they're going to have an online platform that you can go into. And if it's the other carrier that I use, then you're actually going to have to fill out paperwork and process a loan, which is nothing more than filling out a form and then uploading it into their system.
Okay.
Piece of cake.
Okay. So it's not a lengthy, cumbersome
It
process.
does, it doesn't need to be, and it shouldn't. And what I do with clients is, this is anytime something's new, there's always fear associated with it. Fear that you're going to choose the wrong button or make the wrong decision or whatever. So, what I recommend and what I request of all of my clients is that we do the first couple of loan process together. We have my staff has all the forms that we can fill out and send it to you, and then we'll upload it and do that whole thing, show you how to do it and do it for you. And then I also, when we're doing a debt elimination strategy, the conversation we're having right now, just like when I'm working directly with a client, you're gonna forget, and the client's gonna forget 90% of everything I said in about 20 minutes. And that's okay. So we know we're gonna have to have regular conversations. So when I create a debt elimination strategy for someone, I know when the next debt is going to be due to be paid off. And I'm going to say, look, when this happens, this is going to happen in 2.5 months. Before you do that, call us, get on my calendar, and let's walk through it together. And that way that for the client, at least hopefully it makes them feel better because they don't feel like they're being left out in the cold, because that's not the goal here. And
Right.
then after they do it a couple of times, they don't really need me. I've got clients that have been with me for years, and I haven't heard from them when it comes to taking a loan in years. But we talk every year and just do a follow up and see how they're doing, kind of thing.
Okay. Cool. Awesome.
Well, folks, I'm not going to do any more unless anybody has any advanced concept questions. I'll give you one. Uh, so I'm going to use me as an example. So, in doing what I do for a living, the majority of my income is derived by commissions. So, as such, I'm a 1099, meaning that I have to pay my own taxes. So, if you think about paying your taxes like paying the car that I was talking about earlier, the minute I pay my taxes to the IRS, that money's gone. IRS has it. They're happy. They're not taking me to court. They're not seizing my stuff, but the money's gone. The IRS is paid. What if I put that money into an infinite bank first and then let it sit there and then took a loan against it and then paid the IRS? Is the IRS paid? Yep. Are they going to come after me? Nope. Do I still have my money? I paid the IRS with somebody else's money. So that's a strategy that you can use. It's not a, so the IRS bill is a bill. It's not a debt. It's going to come again next year and come again next year. So you can't ever eliminate a bill, but you can make the cost of the bill work for you. In the same respect, if you have a mortgage and it's a conventional mortgage, not a VA, not an FHA, but a conventional mortgage, then your principal, interest, taxes, insurance payment might be paid to your mortgage company. And what you're doing in that example is you're allowing your mortgage company to hold, grow, invest, and make money with your taxes and insurance payment until it's time for them to pay your taxes and insurance payment. Do they pay you anything for that? So it's like you're giving somebody money that they can go invest and make money with as long as they agree to drop the money off eventually at the bank. So if you don't have to do it, and about 60% of commercial lenders that are not commercial, of VA lenders, not VA, sorry, getting tired. About 60% of conventional lien holders, conventional lenders, do not require you to pay them the taxes and the insurance payment. I've seen some people where they're just putting it in the savings account, getting a little bit of earnings, and great. What I'll tell you is if you actually do this process consistently, then over 15 years, you'll be building up enough money in that program where the guaranteed interest and the dividend combined will be enough to pay your taxes and your insurance payment for you forever. That's true debt freedom. And so that's something that I recommend to people when they have a conventional mortgage. Done. Okay. Any last minute questions before I go say hi to my wife and get ready for my 7 o'clock appointment?
No, thank you so much. This
Yeah.
has been super helpful.
All right, folks. Ms. Dickey, hopefully you got something out of this. Are you still there, or are you just present in spirit?
Yes, I'm here.
Great. And Ms. Dickey, how did you get to this event?
Actually, I was looking at watching Coast Live on TV and I saw you. And it
Gotcha.
sounded, matter of fact, for the second time, I said, wow, it sounds interesting. Let me see if I can join the class and see what's going on and go from there.
Well, very good. So if you'd like to have another conversation, you've got our contact information. If you got to this, that means you got an invite. And we'll
Yes,
be happy to have so if you're Coast Live, that means you're in Southeast Virginia.
yes.
What part?
I live in Chesapeake, Virginia.
Oh, okay. I just moved from Chesapeake. So very, very good. All right. Well, Ms. Dickey, reach out if you'd like to have another conversation. Be happy to help if I can. And thank you, Linda and Leanne, for sticking with us, and hope everybody has a good night.
Thanks,
Thank you,
Scott.
Scott. You
Appreciate
too.
it.
Bye,
Thank
folks.
you,
Bye.
Scott.